Stocks in play. When a stock is widely believed to be a takeover target, it is said to be in play. Day traders widely trade stocks in play because their volatility produces reasonable risk and trading opportunities. When company stocks have less volatility, they move slowly, and they only have a moderate price change only when the company shows good or bad trading outcomes. This may occur only a few times in a year. Such companies are ideal for investors looking for returns in the long term. Long-term investors buy shares in these companies, which have good prospects. With shares moving slowly in the right direction, and it matters less to them if the share price doesn't move much intraday. But day traders buy and sell stocks during stock market opening hours and exit the trade before the day ends. Sometimes they even trade for a few minutes or an hour and exit the market. They therefore require more action than investors. They need stocks that move and produce price swings so that their trade becomes worthwhile. Such fluctuations in prices leave enough room for them to realize profits. After paying the association fees charged by stockbrokers for buying and selling shares. Stocks in play also have a large volume. Day traders are after quick entries and exits, and they want liquid stocks. That means they can buy and sell shares in the capital on demand. A stock that doesn't have good liquidity and might cost the broker time to strike a promising buying or selling deal. The broker is unable to negotiate the deal that the trader wants to buy or sell at. For day traders, this is a problem because it means the difference between a profitable trade and a non-profitable one. Day traders are guided by trade volumes in shares that are traded each day to arrive at what they consider good liquidity for them. For most traders, 100,000 shares traded per day would be their minimum, while other traders may require 1,000,000 shares. Stocks in play will change in one day, and an ordinary stock will be put in play by the company news, which is typically released early in the morning, and it will vary depending on the nature of the news, whether it is good or bad. Sometimes good news for traders may be bad news for investors. Some of the big companies like Apple, Amazon, and Facebook have stocks that are always in play, and day traders will have these stocks always in their watch list. This is because they have large volumes of trades and traded shares. This is where a day trader looks for excellent trading opportunities and proper levels to trade from. Float and market cap. Market cap means market capitalization. It expresses the stock value of all the company shares. To arrive at the market cap of an entity, multiply the entity's shares by the stock price. An entity with $50 million in shares, with each share trading at $20, then $10 billion will be its market cap. Market cap is necessary because it helps traders to understand and compare the size of different companies. Market cap helps you to know the worth of different companies in the open market. It also helps you to understand how the market perceives a particular company and mirrors what investors and traders are ready to pay for its stock. Large cap stocks. $10 billion and over is their stock market value. Typically, these are reputable companies that produce quality goods and services. They experience steady growth and have a history of consistency in dividend payments to their shareholders. Their brand names are familiar to national and even international consumer audience. They are dominant players in their respective industries of the establishment. They are ideal for conservative investors since they pose less risk as they have less growth potential. Mid-cap stocks. Typically, these are businesses with a minimum market value of $2 billion and a maximum market value of $10 billion. In other words, their market value is between $2 billion and $10 billion. They are medium-sized, established companies with growth potential. Such companies are either experiencing rapid growth or there is an expectation that they will proliferate in the near future. They are in the stage of boosting their competitive advantage and widening their share of the market. This is a crucial stage since it determines their ability to attain maximum potential. In terms of risk, They have less risk in comparison with new startups. When it comes to potential, they offer more potential than blue chip companies since they are expected to continue to grow until they reach full potential. Small caps. Their market stock value ranges from $300 million to $2 billion. They are growing businesses that are just emerging in the industry. They are at the riskiest and the most aggressive and rely on niche marketing to survive in the industry. Due to limited resources, they are vulnerable to economic shocks. They are susceptible to intense competition and market uncertainties. Since they are new startups, they have high growth potential in the long term, and they are ideal for investors who can cope up with volatile stock price swings in the short run. Speaking of which, float is the number of shares which are available for trading by the general public. Unlike the market cap that calculates the total stock value of all company shares, free float does not include locked-in shares. Locked-in shares are those that are held by company employees and the government. Market cap can be affected by several factors. Market cap can also be impacted when the number of issued shares changes. Market cap can be diluted when warrants are exercised on the stock of the company because the number of shares outstanding will increase. This is because such an exercise is often carried out below the share's market price. Hence, it has the potential to impact the market cap. On the other hand, issuing a dividend or a stock split typically doesn't alter the market cap. To build a stable watch list, comprising large cap, mid cap, and small cap stocks, a trader will have to evaluate their time horizon, risk tolerance, and financial goals. A balanced watch list comprising all the market caps may be ideal in helping to reduce the investment risk. Pre-market gappers. Pre-market trading refers to trading activities that take place between 8 a.m. and 9:30 a.m. Eastern Standard Time every trading day. This is usually before the regular market session begins. Traders and investors monitor the pre-market trading period to judge the direction and the strength of the market while waiting for the regular trading session. During the pre-market activity, there is limited liquidity and volume, while bid-ask spreads are a common thing during the pre-market period. The type of orders that can be used during this period is limited by many retail brokers, even though they offer pre-market trading. As early as 4 a.m., direct access brokers begin to allow access to the pre-market activity to start. It is crucial to bear in mind that there is a limited activity during this pre-market period. The most reliable types of stocks that are beneficial to trade during pre-market activities are gapper or dumper. They are usually viable during the seasons when earnings for various companies are reported. During such season, these stocks gap with the volume either up or down. They are usually triggered by a primary catalyst such as press releases, news, or earnings reports. They can also be reacting to rumors or analysis upgrades and downgrades. It is important to note that stocks tend to get more credibility, follow-through, and consistent volume when they are gapped in reaction to earnings reports and guidance. As you trade during pre-market activity, you should always know that this period is characterized by fewer participants, more extensive spread, and thin liquidity. It is not advisable to trade pre-market unless there is a substantial volume gap that is being driven by a catalyst. Waiting for the market to open is the most suitable option for most traders. Real-time intraday scans. A stock scanner is a screening tool that uses user-selected criteria and trading metrics to search the market and find stocks that meet the set standards. They can be modified to find the most suitable candidates that match user-specific filters using technology. They have helped to streamline the time-consuming task of attempting to trace new trading opportunities. This makes it efficient and convenient for traders to quickly find potential stocks. It is an essential tool for traders and investors due to its speed and convenience. Real-time intraday scans are essential for day traders, and they work to spot stocks during market hours. They produce results that are highly sensitive to time and require the trader to analyze them quickly on the fly to determine whether a trade should be made. Intraday patterns require quick action as they develop and fade within a short period. Real-time intraday scans help day traders to maximize the limited time duration they have to make decisions before the patterns shift. They are a great way to introduce a trader to new stocks, especially when they search the whole market for candidates. These new stocks can then be added to the watch list. These new stocks can then be monitored to get acclimated to the liquidity, trade volume, spread, and the pace of the price action. A trader can dramatically narrow his field by modifying the filters to search only for stocks that meet his desired price range and minimum volume requirements. The ability of the scan to produce accurate results will be determined by the tightness of your parameters. It is good to make sure that the settings have been set correctly to provide precise intraday alerts. Always make sure to validate the accuracy of the scan results, whether you are scanning for pattern ups or preset ones. By prudently leaning the necessary programming, you can customize your scan to produce the results you need. Always remember that the scans are not intuitive, and they may miss the context that determines how effective the pattern is. Planning trade based on scanners. When correctly used, scanners are helpful, enabling the trader to wave through the market noise and concentrate on the most qualified stocks. But as a trader, it is always important to keep in mind that the results produced by a scanner only act as filters. You still need to carry out careful analysis to determine their credibility. Make the necessary confirmation of the setups before you consider a trade. The reliability and accuracy of scanners can be doubtful, mainly if such results have been produced by pattern-based scanners. Sometimes you can spread your trade too thin between candidates when you use scanners in the wrong way. This may create opportunities for you to lose money faster than you expect. Make sure that you understand the criteria better and test the screened results to gauge how reliable the scanner is.